Okay, let's unpack this. You sent us Mr. Cooper Group's latest financial reports, the earnings call details. Curious about, how a major player in the mortgage industry is doing right now, especially with the economy being kind of tricky, and maybe also the role of tech, like AI, in these big operations, or even, the impact of big mergers. So our mission today, take these sources you gave us, distill them down to the essentials, get you the key nuggets of insight.
Exactly. We're synthesizing the key takeaways from Mr. Cooper Group's second quarter 2025 performance. We're drawing directly from that earnings call you mentioned, the leaders.
Hmm.
Jay Bray, Mike Weinbach, Kurt Johnson, plus their 10Q filing, the press release, all of it. The goal is a clear, structured look at their operations, their financial health strategy, giving you those aha moments without drowning you in data. What's really interesting, I think, is how they're managing to do well in such a tough market.
Right. So let's kick off with the big picture then. Jay Bray started the earnings call, calling it a very solid quarter marked by consistent, recurring, and predictable performance. Sounds good, obviously, but how solid was it really? Especially compared to the rest of the industry.
It was, yeah, genuinely solid. Their operating return on tangible common equity, the ROTCE, came in at 17.2%. Now, that's up a bit from 16.8% last quarter, and it's smack in the middle of their own guidance range, which was 16% to 20%. And interestingly, they pointed out that if you adjusted their capital ratio back to where it was at year-end, it's higher this quarter, partly because of the pending Rocket merger.
Yeah.
Their ROTCE would have actually been near the top end of that 16-20% range. So yeah, exceptional performance, really, given the headwinds.
And speaking of those headwinds, Bray also said the company is firing on all cylinders. That's quite a claim, considering the difficult environment. He talked about, the high mortgage rates sticking around, affordability issues, slow home sales, even prices softening in some areas. And here's where it gets really interesting, I think. The Mortgage Bankers Association survey, it showed originators losing money in 10 of the last 12 quarters. 10. So how on earth has Mr. Cooper managed to buck that trend? What's their secret sauce?
That is the critical question, and the contrast is stark. They've posted solid double-digit returns for, nearly 2.5 years straight now. It really highlights the strength of their large-scale platform and their balanced business model. Over that time, the consistent themes: operating leverage, basically, making more money without cost, rising as fast, strong fee income, and just being nimble in originations. And it's not just jargon. They say it's down to their people, their scale, and technology. And that tech piece, especially AI, they say, is accelerating things, improving customer experience and efficiency.
Okay, so really leaning into that people plus tech combo. I saw they even got recognized as one of the best places to work in Texas by the Great Places to Work Foundation. That says something about focusing on the team. But let's look at the financial foundation. How strong is the balance sheet? What does that stability look like?
It looks really good. Very strong, actually. They reported a capital ratio of 26.6%. That's up from 24.4% at year-end, so a nice, healthy cushion there. Liquidity is also robust, $3.8 billion, plenty cash on hand. And asset quality, still looking pristine. Delinquencies actually declined in the quarter, down to just 1%. Plus, their hedging program is working as planned, protecting them from market swings. So yeah, a really strong financial position that lets them navigate choppy waters.
All right, let's dive into the core business then. They split it into two main parts, servicing and originations. Starting with servicing, they generated, $332 million in pre-tax income in Q2, up 15% year over year. What's driving that growth?
Yeah, that's right. The servicing portfolio, that's the total loans they manage, it's holding pretty steady, around $1.5 trillion in UPB. That's unpaid principal balance. That after they brought on the Flagstar portfolio back in Q4 2024. Now, they did see a slight dip this quarter. One client deboarded about $12 billion in loans, and another $50 billion left earlier this month. But, and this is key, they're seeing really strong organic growth too. They landed a new client bringing in about $40 billion in loans expected by year-end. Plus, they're acquiring another $20 billion in MSRs mortgage servicing rights expected in Q3. And the big theme, again, is operating leverage, servicing revenues, up 13% year over year, which tracks that portfolio growth. But operating expenses, only up 6%. That shows the benefit of scale and their focus on efficiency. You mentioned the MBA benchmark survey earlier. Well, according to the 2024 survey, Mr. Cooper's cost to service alone is now almost 50% below the industry average. And that gap, it's actually getting wider.
50% below, that's incredible. That's a huge cost advantage. And you mentioned AI before. How exactly is that fitting into the servicing side, making things more efficient?
It's absolutely crucial. That's one huge benefit of their scale. They can invest heavily in things like AI. They're rolling out new AI tools specifically designed for big call centers. like their own proprietary system, Agent IQ. It's fully rolled out now. Basically, it helps their agents. It interprets what customers are asking, tracks sentiment live, pulls up info the agent needs right away, even summarizes the call afterwards. They're even beta testing what they call true agentic features.
Meaning the AI does stuff on its own.
Yeah, simple tasks initially, like answering basic questions or fetching data in chat, but always, they stress, under strict quality control and human oversight. The goal is a faster, smoother experience for you, the customer, and obviously more efficiency for them. Okay, fascinating stuff on the AI front. Let's pivot now to originations. They generated $64 million pre-tax income, $9.4 billion in fundings in Q2. How's that side of the business holding up, especially with those high rates making new mortgages? Well, less appealing for many.
Well, the direct-to-consumer channel, DTC,
Yeah.
that's actually got really strong momentum. Volumes were up about 40% for the previous quarter. And the mix is interesting. Home equity loans and cash-out refis made up almost 60% of that DTC volume this quarter. They're clearly leaning into that. They did 2 home equity securitizations, bundling those loans and selling them to investors. Got great feedback, apparently. Investors seem to like their track record on loss mitigation, keeping people in their homes. And the potential market here is just massive. They're existing customers. They collectively have over $900 billion in available home equity.
Wow, $900 billion.
Yeah, it's a huge runway for business over multiple years. They really see home equity as a mainstream product now, easy, cost-effective way for homeowners to tap into that value. That is a huge number. So a big focus on home equity makes sense. What about the more traditional refis, the rate and term ones? Is there much happening there?
Well, the opportunity is obviously limited with rates where they are, but interestingly, 22% of their current customers have mortgage rates above 6%. So that means they're still positioned for pretty sizable volumes whenever rates do dip, even if it's just a temporary rally. And operationally, their DTC team has gotten faster. Turn times from application to funding are 6 days quicker than a year ago.
Even with higher volume?
Yeah, despite volumes being 68% higher. That kind of efficiency is really key.
And what about outside of DTC, the correspondent channel?
Right, where they buy loans from other lenders, they become a consistent top 5 player there over the last year or so. And they expect to gain more share, but they emphasize they're doing it while keeping an eye on margins, being disciplined. It's that balanced approach against strength in both servicing and originations.
Okay, now for the really big news. The elephant in the room, maybe. The pending merger with Rocket. Jay Bray mentioned being thrilled about Rocket closing the Redfin acquisition, calling it a major component of the integrated homeownership platform they're building together. What does this monster merger actually mean for Mr. Cooper, for Rocket, for the whole industry?
Yeah, this is definitely transformative. So the announcement came back on March 31st, 2025. Rocket acquiring all of Mr. Cooper's shares. It's an all-stock deal, valued around $9.4 billion in equity based on the exchange ratio they set. They expect it to close in the fourth quarter of this year, 2025, assuming they get shareholder and regulatory approvals, of course. And they've made a point of saying they're already working really closely with Rocket on the integration plans, wanting to, hit the ground running post-close. And as you noted, the fact they didn't take questions on this earnings call because of the pending deal, well, that really highlights how significant and sensitive this transition is. Bigger picture, it creates an absolute powerhouse in homeownership services, covering potentially everything from finding a home to servicing the loan for years.
And they also launched that new MSR fund you mentioned earlier. How does that fit into the strategy, especially with this massive Rocket merger on the horizon?
That's a really good question. So they launched the first MSR fund, $200 million in initial commitments, planning to scale it up fast. They're working with top-tier fixed income investors who see the value in Mr. Cooper's platform for managing those MSRs and maximizing returns. It's that asset-light strategy we talked about, lets them grow the platform, generate fees, without putting all the assets directly on their own books.
So how does it fit with Rocket?
Well, post-merger, think about it. The combined entity will have an even bigger servicing operation. That could make the MSR fund even more attractive to investors. It allows the combined company to keep growing that servicing portfolio, generating those fees maybe more efficiently, without tying up quite as much capital directly. So it could become an even more important strategic tool for the larger combined company.
Makes sense. Okay, looking forward then. How are they projecting the next quarter? And what's the overall liquidity situation look like as they head towards closing this deal?
They're expecting continued strong operating cash flow. That should keep their liquidity position solid through the rest of the year. Liquidity ended Q2 at $3.8 billion. It was slightly lower than Q1, but that was mainly due to the timing of buying a bulk MSR portfolio right at the end of the quarter. Importantly, they've also increased the borrowing capacity on their MSR lines and warehouse facilities. Those are key funding sources. And they remain fully compliant with all their financial covenants, all the requirements from Fannie Mae, Freddie Mac, Ginnie Mae, no issues there.
Yeah.
So for Q3 2025, the guidance is basically more of the same. Continued consistent performance. They sound pretty confident.
Wow, okay. What a deep dive. We've really seen how Mr. Cooper Group is, well, not just navigating, but performing really consistently in a very tough mortgage market, leveraging strong operations, making big moves in AI, maintaining a solid balance sheet, and that strategic focus on areas like home equity, plus this huge upcoming merger with Rocket. It definitely paints a picture of a company right in the middle of a major transformation.
Absolutely. They've shown this remarkable knack for delivering predictable results, adapting to the market shifts. It really sets them apart. That AI integration and servicing, the strategic plays and originations, and just the benefits of their sheer scale, all crucial pieces to their success now and likely going forward with Rocket.
So, what does this whole mean for you listening in? Think about it. How might this blend of AI in customer service, plus this massive merger creating an integrated giant, how might that reshape the whole experience of owning a home? Not just for Mr. Cooper or Rocket customers, but maybe setting new standards for the whole industry. And crucially, what could it mean for you, the possibilities, maybe even the challenges in managing one of your biggest financial assets using this more integrated, tech-heavy approach? Something to mull over.